𝗣𝗟𝗨, the head of research at Fundstrat Global Advisors, just made a bold call to highlight why the market won't fall anymore. In his interview on CNBC, he breaks down why he believes the market won't fall anymore despite everything happening in the macro environment. He says we could be heading back to all-time highs. I'm going to show you the clip first, then I'll break down exactly what he said and what it really means for investors right now. And after that, I'll walk you through 3 insanely cheap stocks that could benefit if he's right. Hit the like button, share the video, and drop your thoughts in the comments. Subscribe so you don't miss the next important investing update. Let's hear what 𝗣𝗟𝗨 has to say.
Now let's bring in Fundstrat's head of research, 𝗣𝗟𝗨, also a CNBC contributor, and as you see here with us at Post 9. It's good to have you back.
Great to see you.
Now what for these markets?
I think the bottom's in, Scott, because last week was a period where the war was getting worse and oil was going up, but stocks weren't going down, so that's a good precondition. And today now we have the rate of change, that the war is de-escalating. So I think stocks are now in the process to go back to their all-time highs, and I think maybe get to that 7,300 that we were expecting this year.
Wow, so let's just remind and refresh people's memories a bit. You were looking for a strong start to the year, stocks falling into potentially a bear market.
Yes.
Most of that you pegged to a new Fed chair coming in and some of the issues that might revolve around monetary policy. Couldn't foresee the outbreak of this war and the conflict, et cetera. Does it matter what caused the bear market for how you project your outlook for the year, or are you confident that we had this event, an existential event for the market, it reacted negatively, and now we're going to rebuild our way back?
Yeah, I think things have possibly changed, Scott, because this war pulled forward a lot of repositioning. You know, we know people have gone flat or raised cash, and they were ready to own defensive positioning. And we also had a rolling bear market last year in energy and financials, and this year in Mag 7 and software. So something like 70% of the S&P has already been through a rolling bear market. So I think the possibility is that the summer lull that could happen won't be as deep because we've already fallen 8%.
What's the makeup of the move back towards record highs like you just said you thought we would do? What does the makeup of the market look like in that scenario?
I think the leadership has been revealed in the last 6 weeks because since the war started, the #1 performing asset class has been crypto, Ethereum, and then energy stocks, Mag 7 software, financials. So to me, that's the group that's leading us up. You know, energy went up for obvious reasons.
Sure. Isn't it going to go down now for obvious reasons?
Yes. And then the negative correlation to oil was the highest in almost a decade for the Mag 7, Ethereum, and software. So I think that as oil flattens or cools or the curve flattens, those names are going to get a bid, and they've gotten already cheap. We know the Mag 7 is trading almost at a market multiple.
When you know, that we sort of banked on the broadening trade, you know, there was a bent towards value, which it had outperformed growth. Is that mostly over now? Because even with oil elevated, we're still going to ask ourselves questions about a slowdown in the economy, right?
Yeah,
or no?
And there's still a shock rippling through the economy.
Which we maybe haven't felt quite yet?
Correct. Yeah, I think there's an inflation shock still coming. I think that the broadening is taking place. The narrowing is, I think, more investors are going to buy U.S. because the U.S. has proven its resilience in this wartime period. Plus, the U.S. makes more money in a war. But the broadening is that more U.S. stocks rise.
Yeah, but if you're telling me the inflation shock is coming, isn't that going to negatively impact the broadening trade?
Yeah, I think it is out there. We just don't know amplitude because, you know, it's like a wave. Like when it hits shore, is it going to be diminished and are people bracing for it? But there should be some inflation shock coming. It sounds like the Fed is already thinking about, you know, still leaning towards cuts, which is good. We'll get some signal.
Well, right now they feel like they're leaning towards doing nothing for the foreseeable future. And if they believe what you just said and believe, then you must believe that they're going to remain on hold for potentially even longer.
Yeah, and it really depends on if consumers and corporates view this as temporary or a change in inflation. So the surveys will matter a lot, as will the incoming reports. But the Fed fund futures show the market's shifting back towards cuts.
All right, so
Right out of the gate, Tom Lee makes a very bold claim. He says he believes the bottom is already in, and the reasoning he gives is actually more important than the prediction itself. He points to a moment where geopolitical tensions were getting worse, oil prices were rising, and yet stocks were not going down. That is a very specific signal. In market psychology, when bad news stops pushing prices lower, it often means that the selling pressure is exhausted. In simple terms, the market has already priced in the fear, so even when new negative headlines come in, they don't have the same impact anymore. Personally, I think this is one of the most underrated indicators in investing. Most people focus on news, but the real signal is how the market reacts to that news. If bad news cannot push stocks lower, that tells you something powerful about positioning, and that ties directly into his next point. He says that the war essentially pulled forward a lot of repositioning. Investors had already gone defensive. They raised cash. They reduced risk. They rotated into safer assets. So when everyone is already braced for impact, there are fewer sellers left. That is where rallies often begin. Now here is where it gets even more interesting. He talks about something called a rolling bear market. Instead of the entire market crashing all at once, different sectors have been taking turns going through their own corrections. Energy and financials were hit earlier. Then more recently, the so-called Mag 7 and software stocks took their turn. And according to him, about 70% of the S&P has already experienced some form of bear market conditions. That is a huge statement, because what that implies is that the damage has already been done beneath the surface. Even if the index itself does not look like it crashed, many individual stocks already did. And I actually agree with this view. If you look at the market over the past year, it has not been a straight up or straight down story. It has been rotation. Pain moves from one sector to another, and by the time the headlines catch up, the market is already transitioning to the next phase. So when Tom Lee says the summer pullback might not be as deep, it is because the market has already absorbed a lot of that pain. Now let's talk about leadership, because this is where things get very tactical. He says that since the war started, the best performing assets have been crypto, specifically Ethereum, followed by energy stocks, and then tech-related names like the Mag 7 and software. This is not random. Energy makes sense because of rising oil prices during geopolitical conflict. But what is more interesting is crypto and tech showing strength. That suggests liquidity expectations and risk appetite are not completely gone. And then he introduces a very important concept: the negative correlation between oil and growth stocks. When oil rises sharply, it tends to hurt growth stocks because it signals inflation and higher costs. But if oil stabilizes or comes down, that pressure eases, and growth stocks can rebound. So his argument is basically this: if oil cools off, the very stocks that were under pressure could become the leaders again. And this is where I want to add my own take. I think this is where a lot of investors get caught off guard. They chase what is currently working instead of anticipating what is about to work next. By the time energy stocks are obvious winners, the opportunity might already be behind you. The real money is made by positioning ahead of the shift. Now the interviewer brings up something important: the idea of a broadening market. Earlier, value stocks were outperforming growth. The question is whether that trend is over. Tom Lee gives a nuanced answer. He says the broadening is still happening, but in a different way. More U.S. stocks are rising, and the U.S. market itself is attracting capital because of its resilience during global instability. He even makes a bold statement that the U.S. tends to make more money during wartime periods. That might sound controversial, but historically, capital flows toward stability. And in times of global uncertainty, the U.S. market is often seen as a safe haven. However, this is where things get a bit more complicated. He also warns about an incoming inflation shock. And this is where I think the conversation gets real, because on one hand, he is saying stocks can rally toward all-time highs. On the other hand, he is acknowledging that inflation pressures are still working their way through the system. He compares it to a wave approaching the shore. You know it is coming, but you do not know how strong it will be when it hits. And in my opinion, this is the biggest risk that investors should not ignore. Markets can rally in the short term on positioning and sentiment, but inflation affects the real economy. It impacts consumer spending, corporate margins, and ultimately earnings. So even if the market moves higher, the path will not be smooth. Then we get into the Federal Reserve discussion. Tom Lee suggests that the Fed is still leaning toward rate cuts, or at least signaling a willingness to support the market if conditions worsen. But the interviewer pushes back, saying the Fed currently looks more like it is on hold, and this tension is critical. because the entire bullish case depends, at least partially, on the idea that monetary policy will not become more restrictive. If inflation forces the Fed to stay higher for longer, that could challenge the rally thesis. So, what you are really seeing in this interview is a balancing act. On one side, you have strong positioning signals, washed-out sentiment, and potential leadership from beaten-down growth stocks. On the other side, you have macro risks, like inflation and uncertain Fed policy. And this is where I think the real takeaway is. Tom Lee is not just saying stocks are going up, he is saying the conditions are in place for a recovery because the market has already digested a lot of bad news, but that does not eliminate risk. It just shifts the probabilities. Personally, I think his framework is useful, but it requires discipline. If you believe the bottom is in, you still need to be selective. You need to understand which sectors are likely to lead the next move, and which ones might lag. And you definitely need to stay aware of macro signals, especially inflation and interest rates. Because if that inflation wave hits harder than expected, it could change everything. At the end of the day, this interview is less about a bold prediction and more about understanding market behavior during uncertainty. It is about recognizing when fear has already been priced in and when the next opportunity might be forming beneath the surface. And that is exactly where smart money tends to move first. Now, let's dive in and talk about the 3 insanely cheap stocks to buy now. Let's start with the first company. We're talking about AbbVie, ticker symbol ABBV. This is one of those companies that a lot of investors think they understand, but very few actually appreciate how powerful the underlying business really is. AbbVie is not just a pharmaceutical company. It is a cash flow machine built on some of the most important drugs in the world. At its core, this business operates in immunology, oncology, neuroscience, and aesthetics. These are not optional markets. These are essential, recurring demand sectors that continue to grow regardless of what the economy is doing. Now here is what makes AbbVie interesting right now. The market has been concerned about the loss of exclusivity for its blockbuster drug 𝗗𝗓𝗏. For years, 𝗗𝗓𝗏 was the single largest drug in the world, generating tens of billions in revenue annually. Naturally, when biosimilar competition entered the picture, investors assumed AbbVie's growth story would collapse. But that assumption is exactly why this stock has become so compelling, because what the market underestimated is AbbVie's ability to replace that revenue. The company has already built a next-generation immunology portfolio led by drugs like SKYRIZI and RINVOQ. These are not small products. These are rapidly growing, high-margin therapies that are gaining market share and expanding into new indications. And here is the key insight. AbbVie is not trying to maintain 𝗗𝗓𝗏-level dominance with one drug, it is replacing it with multiple growth engines. That diversification actually reduces long-term risk. Financially, the numbers reinforce this story. AbbVie continues to generate strong revenue and significant free cash flow, which allows it to maintain one of the most attractive dividend profiles in the market. The stock is currently offering a dividend yield that stands out, especially in a market where income is becoming more important again. And this is where Wall Street's quiet accumulation comes in. When you have a company with durable cash flows, a proven ability to innovate, and a high dividend yield, institutional investors start to take notice when the valuation compresses. Right now, AbbVie is trading at a valuation that suggests low growth expectations. But the reality is that its newer drugs are scaling rapidly, and its pipeline continues to expand. In other words, the market is pricing this like a declining business, while the fundamentals suggest a transition into a new growth phase. And I want to give you my personal take here. This is exactly the kind of setup long-term investors should pay attention to. Not the stocks that are already expensive and crowded, but the ones where the narrative has turned negative while the business remains strong. AbbVie fits that profile almost perfectly. Another important factor is its dividend. In uncertain markets, income becomes a powerful anchor. Investors want cash returns while they wait for price appreciation. AbbVie delivers that consistently, and it has a track record of increasing its dividend over time. That combination of income and growth potential is rare. Now let's talk about the bigger picture. Healthcare demand is not cyclical in the same way other sectors are. People do not stop needing treatment during a slowdown. If anything, innovation in healthcare becomes even more valuable as populations age and chronic conditions increase. AbbVie is positioned right at the center of that trend, and when you combine that with a temporarily depressed valuation, you start to see why Wall Street is quietly stepping in. They are not chasing hype. They are positioning for long-term compounding. Now, is there risk? Of course there is. Pharmaceutical companies always face regulatory risk, pricing pressure, and competition. But AbbVie has already demonstrated that it can navigate these challenges by reinvesting into its pipeline and diversifying its revenue base. That is what separates a one-hit wonder from a durable business. And in my view, the market is still underestimating how successful that transition is going to be. So when you step back and look at it, you have a company with strong cash flow, a growing portfolio of next-generation drugs, a compelling dividend, and a valuation that does not fully reflect its future potential. That is a powerful combination, and it is exactly why this stock is on the radar of smart money right now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. Now let's move on to the second company. We're talking about Novo Nordisk, ticker symbol NVO. This is not just another pharmaceutical company trying to compete across multiple categories. Novo Nordisk has done something very few companies have been able to do successfully. It has built deep dominance in one of the largest and fastest growing health markets in the world, diabetes and obesity. And I want you to really understand the scale of what we're talking about here. Globally, hundreds of millions of people are dealing with diabetes, and obesity rates continue to rise across both developed and emerging markets. This is not a short-term trend. This is a multi-decade structural shift driven by lifestyle, diet, and aging populations. And what Novo Nordisk has done is position itself right at the center of that shift. The company has spent decades refining its expertise in metabolic diseases. That kind of specialization creates a moat that is incredibly difficult to break. Competitors cannot just step in and replicate years of research, clinical data, regulatory approvals, and physician trust. That is the first layer of the advantage. The second layer is its product portfolio. Novo Nordisk's treatments are not just effective, they are becoming the standard of care in many cases. The company has developed therapies that not only manage diabetes but also address weight loss in a way that is changing how doctors approach these conditions. And this is where the story really accelerates. Because for the first time, you are seeing widespread adoption of treatments that directly target obesity as a primary condition, not just a side effect. That opens up an entirely new market. We are talking about a potential multi-hundred-billion-dollar opportunity over time, and Novo Nordisk is already one of the leaders in that space. Now here is what the market often gets wrong. When a company is this dominant in a high-growth area, investors assume the stock is always fully valued. But markets do not price things perfectly. They swing between optimism and pessimism. Even the strongest companies experience pullbacks when expectations get too high or when short-term concerns enter the narrative. And that is exactly what creates opportunity. Novo Nordisk has seen periods where the stock cools off, even though the underlying demand for its treatments continues to grow. That disconnect between price and fundamentals is where long-term investors start to pay attention, because the real question is not what the stock did last month. The real question is where this business is going over the next 5 to 10 years. And when you look at that time frame, the picture becomes much clearer. The global healthcare system is under pressure to reduce long-term costs. Treating complications from obesity and diabetes is incredibly expensive. If you can address those conditions earlier and more effectively, you reduce those downstream costs. That creates a powerful incentive for insurers, governments, and healthcare providers to support these treatments. In other words, demand is not just coming from patients, it is being reinforced at the system level, and that is a huge tailwind. Now let's talk about the financial side of the story. Novo Nordisk has been delivering strong revenue growth, and that growth is being driven by real demand, not just pricing power. The company has also maintained strong margins, which tells you that it is not sacrificing profitability to scale. This is important because it shows discipline. A lot of high-growth companies burn cash to expand. Novo Nordisk is growing while maintaining profitability, which is a very different dynamic. And then there is the pipeline. This is something that does not always get enough attention. Novo Nordisk is not standing still. It is continuously investing in next-generation treatments, expanding into new indications, and improving existing therapies. That ongoing innovation reinforces its leadership position. Because in healthcare, staying ahead is not just about what you have today. It is about what you are building for tomorrow. Now let me give you my honest take on this. I think Novo Nordisk represents one of the clearest examples of a company benefiting from a long-term, unavoidable trend. This is not a cyclical opportunity, this is a structural shift in global health. And when you combine that with a company that has already proven its ability to lead in that space, you have a very compelling setup. But here is the key. Even the best companies can become bad investments if you overpay for them. That is why timing and valuation matter. And when a stock like this pulls back or consolidates while the underlying business continues to strengthen, that is when it becomes interesting again. That is what we are seeing right now. Wall Street is not ignoring this company, it is watching closely. And when the valuation becomes more reasonable relative to its growth potential, capital starts to move in quietly. Because smart money is not chasing headlines, it is positioning for the next phase of growth before it becomes obvious. And if the demand for obesity and diabetes treatments continues on its current trajectory, which all signs suggest it will, Novo Nordisk is going to remain at the forefront of that movement. That is why this stock deserves serious attention right now. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now let's move into the third company, and this one brings a completely different dynamic to your portfolio. We're talking about Verizon Communications, ticker symbol VZ. If AbbVie represents durable healthcare cash flows and Novo Nordisk represents explosive long-term growth in a critical global trend, Verizon represents something just as powerful but often overlooked in today's market. Consistency. This is a company that sits at the backbone of modern communication. Every call, every text, every stream, every piece of data moving across mobile networks depends on infrastructure like Verizon's. This is not a luxury service, this is essential, and that is what makes this business so interesting right now. Because despite its importance, the stock has been under pressure. Investors have been worried about rising interest rates, capital expenditures for network upgrades, and competition within the telecom space. Those concerns have pushed the valuation down and driven the dividend yield higher. But here is where things start to shift. When you look beyond the short-term noise, Verizon is still generating massive and consistent cash flow. The company continues to produce strong operating income, and that supports one of the most attractive dividend yields in the market. This is not a speculative yield, this is backed by real recurring revenue from millions of subscribers, and that is key. Telecom is one of the most predictable business models out there. People do not cancel their phone plans during economic downturns. If anything, connectivity becomes even more essential. So while growth might not be explosive, the stability is undeniable. Now let's talk about why Wall Street is quietly accumulating this stock. When interest rates stabilize or begin to decline, high dividend stocks tend to become more attractive again. Investors start looking for income, and companies like Verizon suddenly come back into focus. Right now, Verizon is offering a yield that stands out in a market where reliable income is becoming harder to find. And because the stock price has been under pressure, that yield becomes even more compelling. This is where long-term investors start to step in. They are not looking for the next hype-driven rally. They are looking for dependable returns, both in the form of dividends and potential price recovery as sentiment improves. Another important factor is Verizon's investment in its network. The company has been spending heavily to expand and upgrade its 5G infrastructure. In the short term, that puts pressure on margins and cash flow, but in the long term, it strengthens the business, because whoever controls the best network controls the customer experience. And in a world where data usage continues to grow exponentially, that advantage becomes more valuable over time. Here is my take on this. Verizon is not the kind of stock that will double overnight. But that is not the point. The real value here is in the combination of income, stability, and gradual appreciation. This is the kind of stock that can anchor a portfolio, especially during volatile periods. And when you can buy that kind of stability at a discounted valuation, it becomes even more attractive. Now let's step back and connect everything we've covered so far. You have AbbVie, a healthcare leader transitioning into a new growth phase while maintaining strong cash flows and dividends. You have Novo Nordisk, dominating one of the fastest-growing markets in healthcare with long-term demand that is only increasing. And now you have Verizon, providing essential infrastructure with consistent revenue and a high yield that rewards patience. These are three very different businesses, but they share one critical trait. They are all being underestimated by the market right now, and that is where opportunity comes from. Because when sentiment is low but fundamentals remain strong, that is when smart money starts positioning. Now here is the question I want to ask you. Which of these businesses do you think has the strongest long-term advantage? Is it AbbVie with its diversified drug portfolio and strong cash flow engine, Novo Nordisk with its dominance in obesity and diabetes treatments, or Verizon with its essential role in global connectivity and consistent income? Let me know in the comments because I want to see how you're thinking about these opportunities. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. At the end of the day, investing is not about chasing what is popular. It is about identifying strong businesses when they are temporarily out of favor and positioning yourself before the market catches up. These three stocks represent different paths to long-term wealth, growth, income, and stability. And right now, all three are offering something rare: value. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.